Have you ever invested, felt proud of your returns, and then realized later you had no idea how much of that money you actually get to keep? Like thinking you made 1,000 euros, but taxes quietly took a big piece of it. In this video, we'll break down the 5 taxes that can silently eat your investment returns, why your country, not your investments, might be your biggest risk, and how to avoid the most expensive mistakes without reading tax codes. I'm Francesca. For those of you who don't know me, I'm an ex-investment banker turned financial educator and founder of Centsational Women, the leading investing education brand for women in Europe. And if you want to finally feel clear and in control of your money, subscribe to this channel before we start. All right, let's be honest. For most women I speak with, the fear isn't investing. It's the fear of making a mistake with taxes. And that fear, it's valid because taxes don't matter. They can eat into your returns year after year. And the worst part, you often don't realize it until it's too late. Let's break down the 5 most important taxes you might face as an investor in Europe. Capital gains tax. So this is the most obvious one. Anytime you buy something at a low price and later sell it for more, you might owe tax on the profit. Let's make an example. Let's say you buy 3,000 euros of LVMH stock and sell it for 4,200 euros. That 1,200 euros of difference is considered a capital gain. So depending on your country, you might pay anywhere from 0 to 30% on that gain. Some countries may not tax capital gains at all, the rest of them do. The dividend or distribution tax. Own shares that pay you income like dividends from stocks or, let's say, ETFs. Okay, that income is taxable too. Let's make an example. You own shares of a dividend-paying fund. It pays you 600 euros this year. That amount may be taxed, even if you were invested and don't touch the money. And yes, in many countries, you'll get taxed twice. First, in the country where the company is based, and then again in your country of residence. So unless there's a treaty or exemption. It's complex, yes. It's avoidable sometimes. Then transaction tax or financial transaction tax. This is a small fee, usually a percentage, that gets added every time you buy or sell certain financial instruments. So these fees might seem small, but they add up fast if you're actively trading or rebalancing too often. Then wealth tax. Here's where things get surprising. Some countries in Europe don't just tax your income or your profit, they tax your net worth. Let's say in Spain, if your net wealth exceeds around 1 million euros, including investments, properties, and cash, you could own an annual wealth tax, even if your portfolio didn't grow. So the amount depends on where you live. But the key is it's based on what you have, not what you earned. Only a few countries in Europe still apply annual wealth taxes, including Spain, Norway, and Switzerland. But even in countries without a wealth tax, like the Netherlands or Belgium, there are still yearly taxes on investment assets that can catch you off guard. And this is why asset location and planning matters. Exit tax. This one catches many women by surprise, especially nomads or expats. Let's say you invest while living in country A, and later on you move to country B. Even if you haven't sold your investments, country A might say, "Wait, we see you've made a paper profit while living here. Before you leave, pay your tax." France, Germany, and Spain all impose exit taxes under certain conditions, usually on significant shareholders or high net worth individuals when, they give up tax residency and move abroad. So what can you do? First, don't panic, but do plan. At Investing School, we dedicate an entire module to all about taxes. So you know exactly how to, understand what applies in your country, avoid double taxation, choose tax-efficient ETFs and brokers, keep more of what you earn. And for women in our elite level, we go even deeper. You get one-on-one support to evaluate cross-border risk. Because let's face it, you're not just building a portfolio, you're building freedom. If this is helping you see money more clearly, subscribe. This is exactly what we do here. So not to panic, just to notice. Because, clarity starts with awareness. And I created our free investing workshop to really help you understand how to build wealth without second guessing every decision or worrying about hidden mistakes like this. It's calm, it's practical, and it's designed for women who want clarity, not confusion. So here's what I want you to remember. Investment returns are great, but only if you get to keep them. Taxes aren't optional, but confusion is. The more you understand the rule, the more confident you become. And if you enjoyed this, subscribe to this channel. Don't forget, because financial clarity is not a luxury, it's a skill. And as always, see you in the next video and stay sensational.